Good morning, everyone. And that tear I spoke of yesterday of equity markets to the upside late afternoon video, that really was totally rejected by New York trading. So that was very much Asia just getting carried away with itself, doing the usual, what Asia does, just buy every day. So it'll be interesting to see if Asia is buying today, because that clear rejection last night in New York trading was pretty profound. There are serious sellers accumulating on the top side, which is something we haven't quite seen before. Usually the sellers capitulate at the first signs of a major rally, but not on this occasion. So that's interesting from a price action point of view. From the economics point of view, consumer expectations of inflation in the United States was 6%, up significantly again. And that just goes to show that people will be factoring into their lifestyles, to their consumer behavior, expectations of ongoing high inflation. Again, combining that with overall consumer sentiment in the US, which is really languishing at incredibly low levels, it's not a very positive outlook for consumer activity over the next few months. The really big number, though, perhaps, was the German wholesale inflation number, which was over 16%. It was around 15.2 last time, over 16% for wholesale price inflation. Most of that, virtually all of that, will be passed on to the European consumer. Inflation is completely out of control, and yet people are still trying to talk about it as something that might be good out of economic activity. It's a function of price gouging and now increasingly defensive business practice, because of the uncertainty of the future going forward. People are pricing in a margin to absorb future shocks, and that's why this inflationary surge is permanent. Prices won't be going back down. And this sort of price gouging or freedom of pricing that large businesses and small businesses are now allowed to pursue, given all the uncertainty and dislocation of the pandemic, is going to eat away at every capitalist economy in the world in a profound way. This is not a good thing. This is not something the Federal Reserve will quickly look after by raising interest rates slightly. They'll raise interest rates significantly and it still won't work. Inflation over the next 2 to 3 years is going to be a very ugly monster indeed. In terms of equity markets going forward, look, if you've been long for a long time, you've got to take some chips off the table. That's all I'm saying. It always looks good at the top, and at the moment it's starting to not look good. So we've already passed that stage. On currencies, some consolidation, further weakness in the Australian dollar. The Australian dollar downtrend is a thing I've spoken of a lot and will continue to 65 cents in next year, 2022, maybe 58 cents in 2023. But it's the dominant risk direction you need to be aware of when you're hedging imports or exports or trading currencies. And that's certainly to the downside for the Australian dollar. On the day, I wouldn't mind, I would expect some kind of rally in the Australian dollar, for a brief rally, but it is a rally to sell. Gold's consolidating, still bullish long term, but as I said, this would require patience, buying small amounts here and there, and continue to pursue that policy. Oil looks a little tired, to be honest. And the euro and sterling really in a consolidation phase. The US dollar is going to mark time here a little bit. The Aussie is going to be weak. I am still very concerned about equity markets. I hope you have a fabulous day as the holiday seasons approach. All the best. Clifford Bennett, Chief Economist, ACY Securities. Thank you.